Good day, everyone. This is your European Open briefing for Tuesday, 6th of September 2016. My name is Michael Frentiades and I'm the Chief Economist here at XM.com. And these are the key points you should know about today. Well, the US dollar and maybe the euro and the yen were relatively quiet, so not much action in the majors because of Labor Day in the most important majors. The Aussie cruised to a 10-day high versus the US dollar after the RBA held rates unchanged. Sterling yesterday was helped by yet another PMI services this time, another strong PMI business survey. Oil was volatile until details of the Russia-Saudi Arabia agreement emerged. And today we had disappointing German industrial orders. Eurozone GDP revision will be on top, and ISM manufacturing in the US later today. Also earlier we had Aussie current account deficit smaller than expected. Now, on to the main news of today was the Reserve Bank of Australia. Of course, it kept rates steady at 1.5%. Well, the RBA would not cut 2 times in a row without like some really dramatic happening. It's not its character. It's not its character to be cutting rates continuously. So economists were unanimous in expecting steady rates, and they got it right, of course. Positive economic news are keeping the bank on hold. The language on Aussie strength was not so aggressive. The RBA just said that the stronger Aussie might complicate issues, so it was not such a strong warning. Now, it's very interesting, as you see from the chart here, that the RBA's 2 cuts did not lead to more Aussie selling. You see the first cut that took place was in May, and the Aussie has been it found like a near-term bottom there, and it has been rising since. And the second cut back in August also did not dent Aussie strength as much. Why is that? Because, well, during this year the Fed has refrained from further hikes, from the hikes it promised. Also, the ECB and the Bank of Japan went negative. Brexit also happened, so Australia is a bit of a safe haven. And another issue is also, well, you can see here also the positive action, now trading above, comfortably above 76 cents today, whereas it had some trouble the previous day, breaking above 76 cents. Now, what is the Aussie eyeing? Well, the 70 cents, the 77.5 level, which would be a 1-month high, and then the 78.33, which is a 1-year high. The RBA statement was more neutral, I would say, than dovish. So the Aussie bulls might hope that the country will maintain its yield advantage over the other majors. It's very difficult to find a country with an interest rate of 1.5%, such as Australia, so that is benefiting the Aussie for now. There is one more cut penciled in by most economists, either during the 4th quarter or the 1st quarter of next year. So we'll see how it goes. Another currency that is doing well, since it was more or less quiet for the other majors, was the pound. It is now holding above the 133 level versus the US dollar. It actually reached 7-week highs yesterday above 133.70. We had a strong beat by PMI services. It came in at 52.9 versus 50 that was expected, and 47.4 the previous month. Now, the PMIs have showed that UK is recovering from the initial Brexit shock. Now, Prime Minister Theresa May has warned that there will be economically difficult times ahead, so enthusiasm should be moderated. But what happened in the market, I think there was excessively one-sided market positioning, and this was wrong-footed by the surprisingly positive economic news, by the post-Brexit bounce from the initial shock, let's say. Moving on, it was a pretty wild day in the oil market, as what was first thought to be an agreement between Russia and Saudi Arabia to limit production was actually not exactly that. It was a forming of a group to monitor the situation. The two countries said that there was no need for a production freeze, so you see a big jump in oil almost to the $47 a barrel level, and then coming back to around 45. Yes, a bit higher on the day. This has helped to stabilize the oil market, but not as exciting as what might have been, let's say. Onto the calendar, one of the first items of news was the current account deficit from Australia, substantially lower than expected, so this is another help for the Aussie. German industrial orders from their part were disappointing, 0.2% versus 0.5%, while the revision for the Eurozone GDP for the second quarter should leave it unchanged at 0.3%. Just keep in mind that there were not so good news for the Eurozone. Yesterday, the Eurozone services PMIs final were revised down, and that was negative for the Euro, so difficult to see the Euro. Especially that might be addressed also by the ECB meeting we have in a couple of days, so not so good. We are going to get new forecasts as well from the ECB staff. ISM non-manufacturing will be interesting later in the day, as after the big miss by its manufacturing PMI ISM brother the previous week, we'll see whether the non-manufacturing or services sector is holding up better. And there will also be a speech by the Swiss National Bank's President Jordan later in the day. So that's all from me today. Thank you very much for watching, and have a great day.